Brad Williams, Frugal Finance, defensive stocks, what they are, benefits and drawbacks, and examples. What are defensive stocks? Defensive stocks are shares from companies that provide reliable dividends and consistent earnings even when the broader stock market is struggling. These companies produce products or services that people continue to need regardless of the economic climate, making them less vulnerable to market swings. It's important to differentiate defensive stocks from defense stocks, which belong to companies involved in producing military products like weapons or ammunition. Key highlights: defensive stocks are known for steady dividends and stable earnings, irrespective of market fluctuations. Well-established companies like Procter & Gamble, Johnson & Johnson, Philip Morris International, and Coca-Cola are prime examples of defensive stocks. While they offer more stability, defensive stocks tend to see slower growth compared to more volatile stocks during bull markets. Their lower market volatility can limit potential gains, especially in periods of market expansion. Understanding defensive stocks. Investors often shift to defensive stocks in times of economic uncertainty or when higher market volatility is expected. Stocks provide a safeguard thanks to their ability to maintain strong cash flows and consistent performance, even during recessions. Many defensive stocks also pay regular dividends, which can act as a cushion during market downturns. Some of the biggest names in defensive stocks include Procter & Gamble, Johnson & Johnson, Philip Morris International, and Coca-Cola. These companies' operations are robust enough to withstand economic stress, making their stocks attractive to risk-averse investors. But why opt for defensive stocks instead of a safer option like Treasury bills? Despite their relative low-risk nature, defensive stocks provide higher returns than risk-free alternatives, especially in a low-interest rate environment. In times of financial instability, these stocks balance fear with moderate growth potential. Investment managers often turn to defensive stocks when they predict tough economic conditions, knowing these companies can endure where others might falter. While they may not deliver outsized returns during periods of economic growth, their steady performance offers a solid buffer during downturns. Defensive stocks typically have lower betas, less market-related risk, often below 1.0. This means their price fluctuations are generally smaller compared to the broader market. For example, a defensive stock with a beta of 0.5 would typically decline by only 1% if the market dropped by 2% in a given week. Advantages of defensive stocks. One of the primary benefits of defensive stocks is their ability to offer consistent, long-term returns with relative lower risk. They tend to have higher Sharpe ratios than the broader market, indicating that they provide better risk-adjusted returns. This makes them an attractive option for investors looking for more predictable outcomes without the need for excessive risk-taking. Warren Buffett's success as an investor is partly attributed to his focus on companies that demonstrate resilience and stability. Characteristics found in defensive stocks. By prioritizing stability and minimizing losses, defensive stocks often outperform riskier investments over time. Disadvantages of defensive stocks. On the flip side, defensive stocks may underperform in bull markets due to their lower volatility. As a result, many investors become frustrated when these stocks fail to deliver large returns during periods of economic growth. This can lead to missed opportunities for greater gains. Additionally, some investors make the mistake of timing the market, rushing into defensive stocks after a market drop, which can hurt overall returns. Timing mistakes, such as buying defensive stocks too late in a downturn, can reduce the effectiveness of these stocks as a hedge. Examples of defensive stocks. Defensive stocks are often characterized as non-cyclical, meaning their performance is not closely tied to business cycles. Here are some types of defensive stocks. Utilities. Utility companies, such as those providing water, electricity, or gas, are considered defensive due to their essential services. Regardless of the economic environment, people need these services. Lower interest rates during economic slowdowns also benefit utility companies. Consumer staples, companies that deal in essential products like food, beverages, hygiene items, and household goods tend to do well even during tough times. These companies generate reliable revenue and profits as consumers continue to buy these necessary products no matter the state of the economy. Healthcare stocks, pharmaceutical companies, and makers of medical devices are often seen as defensive. There will always be demand for healthcare services. However, these stocks may face more competition and regulatory uncertainty than some other defensive sectors, making them slightly less predictable. Apartment REITs. Real estate investment trusts focusing on residential properties can be considered defensive since housing is always in demand. However, it's important to avoid REITs that focus on luxury apartments or office space because they may face challenges during economic slowdowns. What are dividends? Dividends represent a portion of a company's earnings paid out to shareholders. These can be in the form of cash or additional shares of stock. While dividends can provide a steady income stream, not guaranteed, and companies may reduce or eliminate them if financial conditions worsen. When does a poor economy become a recession? A recession in the U.S. is officially recognized when the National Bureau of Economic Research declares 2 consecutive quarters of negative GDP growth. It's a formal declaration, not just a general perception of economic decline. Why are Treasury bills considered risk-free? Treasury bills are considered risk-free because they are backed by the United States government's credit. When you invest in T-bills, you're essentially lending money to the government, which guarantees repayment with interest, making them a secure investment. Conclusion: defensive stocks offer a reliable and stable way to generate income and protect portfolios during uncertain times. While their returns may be more modest compared to growth stocks, their lower risk profile can make them a valuable part of a balanced investment strategy. If you're considering including defensive stocks in your portfolio, it's worth consulting with an investment advisor to ensure the best mix of stability and growth. If you have any questions regarding defensive stocks, comment. Brad Williams, Frugal Finance. Thanks for watching. Hope that helps. See you soon.